The semiconductor sector is currently experiencing a rare confluence of technical indicators, hinting at a potential short squeeze despite broader market unease. Here at the lab, we're tracking SMH, SOXX, and SOXL, noting SMH's unusual volume divergence pre-market. With fear and greed at an extreme 8 and Trump policy risk at level 3, we'll dissect these critical ETFs to navigate today's volatile landscape. Alright Denver Stock Lab, let's dive into the VanEck Semiconductor ETF, SMH, which saw a minus 1.49% dip today, landing at $368.66, as the technology sector feels the pressure. This ETF has been on a tear, up an incredible 1,276.8% year-to-date, but recent headlines like VanEck sheds $465 million suggest some shifting tides. The question now is, can SMH maintain this momentum amidst evolving market dynamics? The VanEck Semiconductor ETF has approximately $6.7 billion in assets under management, providing decent liquidity. With an expense ratio of 0.35%, it's relatively affordable for its category. The fund's impressive 1,276.8% YTD return and 44.5% 3-year average are notable. Top holdings include Nvidia, TSM, and Broadcom, indicating significant exposure to industry leaders, which may contribute to its high returns but also potential volatility. Alright, Denver Stock Lab fam, let's dive into SMH's technical setup. With an RSI of 33.4, SMH is in neutral territory, suggesting no extreme overbought or oversold conditions. Price is right on top of both its 20-day and 50-day moving averages at $368.66, indicating a short-term bearish trend. Keep a close eye on support at $350.23 and resistance at $387.09. Momentum seems to be fading, and a confirmed break above resistance would signal a potential trend continuation. Alright, Denver Stock Lab viewers, let's talk macro for SMH. The ongoing US-China trade tensions, highlighted by those recent headlines about Trump tariff uncertainty, are a huge force here, impacting export controls and borrowing costs. Our AI score of 45 signals some near-term uncertainty. Keep a close eye on electric vehicle adoption as a key upside catalyst. For you, the retail investor, stay diversified and watch for any easing in trade rhetoric.
Denver Stock Lab.
Alright Denver Stock Lab, let's dive into the iShares Semiconductor ETF, SOXX, which is feeling the pressure today, down 2.28% at $316.12. This tech-heavy fund, despite its incredible 1,695.7% YTD surge, is grappling with the latest headlines. We're seeing markets stumble as global trade faces more Trump tariff uncertainty, directly impacting this sector. The big question now is, can SOXX navigate these geopolitical headwinds, or is more volatility on the horizon? Alright, let's dive into SOXX's fundamentals. While we don't have the exact AUM, fund size is crucial for liquidity, especially when trading. The expense ratio is also unavailable, but in the tech ETF space, we're typically looking for something competitive. Now, those returns are eye-popping, nearly 1,700% YTD and a 32.7% 3-year average. That's incredible performance. Looking at top holdings like MU, Applied Materials, and Nvidia, it's clear SOXX offers concentrated exposure to key semiconductor players, indicating a high-growth, but also high-risk, profile. Alright Denver Stock Lab fam, let's dive into SOXX's technical setup. The RSI is sitting at 35.7, which is pretty neutral, suggesting no extreme overbought or oversold conditions right now. Interestingly, the price is right on top of both its 20-day and 50-day moving averages at $316.12, indicating a short-term bearish trend. Keep an eye on that $300.31 support level below, and $331.93 for resistance. Momentum seems to be fading, and a break above resistance would confirm a bullish continuation. The US-China trade war is the main macro force driving SOXX. With the AI score at 41, near-term direction looks uncertain. A recent headline, "Stock markets stumble as global trade faces more Trump tariff uncertainty," highlights the trade policy impact. Watch for a potential US-China trade deal as a catalyst. For retail investors, consider a cautious approach, as a trade deal could boost SOXX, but a downturn could reduce demand. Trade tensions and tariff uncertainty are driving the Direxion Semi-Bull 3X ETF down 7.25% to $43.23, a trading leveraged equity fund. With a year-to-date gain of nearly 4,940.8%, this ETF's performance is closely tied to the volatile semiconductor sector. As stock markets stumble amidst global trade uncertainty, will the SOXL's fortunes change, and what's next for this high-flying fund? Alright, let's dive into SOXL's fundamentals. You'll notice the AUM and expense ratio are blank. That's common for these highly leveraged, daily reset ETFs, as they're not designed for long-term holding. But let's talk performance, a mind-blowing plus 4,940.8% YTD and a plus 43.8% 3-year average. This fund is absolutely crushing it, reflecting the semiconductor boom. Yet, look at the holdings, MU, AMAT, NVDA, AMD all show 0%. This isn't a typical index fund, it's using derivatives to achieve its 3x leverage, so direct stock ownership isn't the primary driver of its risk exposure. Alright, Denver Stock Lab fam, let's dive into SOXL's technical setup. The RSI is sitting at 34.7, which is pretty neutral, not oversold, not overbought, just hanging out in the middle. Right now, the price is exactly at both its 20 and 50-day moving averages at $43.23. That means the short-term trend is looking bearish. We've got support at $41.07 and resistance at $45.39. Momentum is definitely fading, and we'd need a clear break above that resistance to even think about a bullish trend continuation. The main macro force driving SOXL is trade policy, with the US-China trade tensions being a significant catalyst. The recent headlines on Trump's tariff uncertainty are weighing on the sector. The AI score of 42 implies a cautious near-term outlook. Investors should watch the outcome of US-China trade negotiations. As a result, retail investors should consider a wait-and-see approach before buying into SOXL's volatile trend. A 1.08% gain is driving ProShares UltraPro QQQ, a leveraged equity ETF, to $39.19. As a trading-focused fund, its price movement is closely tied to the QQQ. With a year-to-date loss of nearly 593%, investors are closely watching its recovery potential. Recent flows of $847 million into TQQQ, as reported in daily ETF flows, signal growing interest. What's next for this volatile ETF? For TQQQ, the fund size and expense ratio are not available, which raises concerns about liquidity. The YTD return is minus 592.8%, while the 3-year average is 47%, indicating significant volatility. Top holdings show zero allocation to major tech stocks like NVDA, APL, and Microsoft, suggesting the fund's actual risk exposure may differ from its intended tracking. The RSI reading of 24.5 indicates oversold conditions, potentially setting up a mean reversion entry point. Price is aligned with both MA20 and MA50 at $39.19, with key support at $37.23 and resistance at $41.15. Momentum is currently fading, but a break above $41.15 could confirm a trend continuation, while a drop below $37.23 would suggest further downside. The main macro force driving TQQQ is the ongoing US-China trade tensions and Fed rate policy. Recent tariff uncertainty headlines, like "Stock markets stumble as global trade faces more Trump tariff uncertainty," are impacting the sector. With an AI score of 48, near-term direction is uncertain. Watch for strong earnings reports from top tech companies as a potential catalyst. Investors should be cautious and consider hedging their bets amidst this uncertainty. A 1.44% gain is driving the global xCloud computing ETF, a technology sector fund, to $19.07 today. As a cloud-focused ETF, it's noteworthy that cloud ETFs have been shining despite market sell-offs. With a significant year-to-date decline of 1,694.7%, investors are looking for a rebound. Can this momentum continue, or will macro headwinds stall its progress? For the global xCloud computing ETF, the AUM and expense ratio are not available. Typically, larger funds offer better liquidity. The expense ratio would be key to determining if it's cheap or expensive. With a minus 1,694.7% YTD return, performance is a concern. Top holdings like AKM, Direxion, and DLR show minimal allocation, suggesting the fund's actual risk exposure may be different from its intended cloud computing focus. The RSI reading of 41.3 is neutral, indicating no extreme positioning. The price is aligned with both MA20 and MA50 at $19.07, showing no clear trend advantage. Key support is at $18.12 and resistance at $20.02. Momentum is neutral, and a break above $20.02 could confirm a trend continuation, while a drop below $18.12 would suggest fading momentum. The main macro force driving CLOU is trade policy, with the US-China trade tensions posing a significant risk. The AI score of 39 out of 100 implies a cautious near-term outlook. Watch for developments on Trump's tariff uncertainty, as seen in the headline. Stock markets stumble as global trade faces more Trump tariff uncertainty. Retail investors should consider a wait-and-see approach before investing in CLOU. TQQQ held strong today. If you found this analysis helpful, please subscribe, like, and comment below with the stock you'd like us to cover next. Remember, this is for educational purposes only, not financial advice, so do your own research and consider that past performance doesn't guarantee future results. Thanks for watching Denver Stock Lab. We appreciate your support.